Yeah. Convertible bonds. So convertible bonds allow you to switch your stats. Now we have two convertibles on the test, Brian. We have convertible preferred stocks and we have convertible bonds. And that's going to be important because, depending on whether it's a convertible preferred stock where par is 100 or a convertible bond where par is 1,000 will affect, which is important to us, is what's called the conversion ratio. So here I've got an example of the Starbucks convertible debenture that was issued early in the Starbucks life stage. And at the time, Starbucks didn't pay anything in the form of a dividend. And the stock was 38. And I was thinking about buying these convertible bonds in the primary market. I think, well, this isn't so bad. I lend Starbucks $100,000, 100 bonds. They agree to pay me 6%, $6,000 in two semi-annual installments, 3,000 in January, 3,000 in July. And right now, it makes no sense to convert into $40 stock that's presently priced at 38. The idea here is Starbucks is going to take the proceeds, they're going to build the business, and in 10 years, they're going to say, Dean, do you want X number of shares of Starbucks, or do you want your $1,000 back? What they're hoping, and I'm hoping, is that the stock will be worth more than the bond, and they won't have to pay back the borrowed funds. The first very important thing for us as a test taker, as I said, we are going to have to calculate parity, and you can't calculate parity without knowing the conversion ratio. So one of the mental notes we need to make to ourselves is when given the conversion price, we need to establish the conversion ratio. It's much more important to know how many shares I could exchange the bond for than it is to
Right.
know that price. So the way we do that is we're going to take par, which is
1,000
1,000.
over 40.
That's right. And now we're back in business because now we get the conversion ratio. And that's going to be important for us to make decisions about whether or not we want the stock or the bond. The
Hmm.
conversion ratio is 25 shares. And again, we could go either way. But as I told you, the concept that is most important for us is not the conversion price. What is most important for us is the conversion ratio, how many shares we can get.
Wait, sorry, go back for a second. Just the bottom part, conversion ratios.
Yeah, so in other words, on the test, I say the conversion ratio is 25. What's the conversion price? Then we would
Right.
go the other way. As I said, I don't think you're going to see that on the test. I think what you're going to see is this conversion price, right? That's what you got to get to is have the
Hmm.
ratio. So,
Hmm.
I joke. I think we should kind of be proactive when we're reading. And so I kind of joke if they give me the conversion price, they say bastards. I don't need
Right.
the conversion price. I need the conversion ratio. That's an intermediate step that we may have to do when we're looking at convertibles. All right, so
Hmm.
the common stock price. So after these bonds were issued, Starbucks built the business and the stock went to 50. And obviously, the stock price and interest rates are going to drive this bond price. It's not testable, but if the conversion price doesn't make sense, it's called a busted convertible, and that just means it's going to trade like a bond if this conversion feature doesn't have any thing left in terms of attractiveness. Now, as I said, the thing we're going to have to do on the test is calculate parity. Parity means when the value of the bond and the shares are equal. And again, based on that calculation, deciding again whether we want to exchange the bond for the stock or not. And so
Hmm.
that's called parity, and you're going to have to do that. The one that's on the test more often than not, I'm going to show you both, is parity of the stock. So I'm going to show you both parity of the bond. We're going to take the current market price of the stock. We're going to times it by the conversion ratio and get parity of the bond. If the stock is 50, I'll just do it right here. If the stock is now 50, Starbucks is trading at $50 a share, and we can get 25 shares of this stock, then parity of the bond when they're equal is 1250.
Hmm.
Do it this way because that's how it's going to compare. Now, if you see this in the real world, give me a call, Brian. But in the real world, I don't think we would see an arbitrage opportunity.
Hmm.
Arbitrage is profiting from price discrepancies.
Hmm.
And if we saw this bond trading for $1,100, there'd be an arbitrage opportunity, right? Because this bond is worth 1250 of the stock. Now, arbitrage opportunities don't exist too much in the real world, but in Series 7 fantasy land, you might be called upon to recognize an arbitrage opportunity where there's a price discrepancy between parity. We would expect in the real world. Now, good news, after you pass your Series 7, you get to leave Series 7 Fantasyland.
Hmm.
I'm stuck here permanently. No wonder I'm demented. I never get to leave the Series 7 Fantasyland. We would have the expectation that this bond. Oh, I forgot you wanted me to record this. My bad. Oh, I did. Okay, cool.
You did, yeah, yeah.
Yeah, okay, cool. Um, we would have the expectation that the bond would be trading in the secondary market somewhere above parity. So you're asking about buying my bond. You said, well, Dean, you're asking 1,300 for the bond and it's only worth 1,250 of the stock. I say, indeed, but you're asking me, Brian, to leave the party early and it's pretty happening party. And so, yeah, I want a little extra. So that's what we would expect. We'd have the expectation that in the secondary market, this would be trading. Now, the other thing, I'm going to show this to you a couple times, but the other thing we might be called upon to do on the test is to take that current market price of the convertible and say, okay, let's divide that and come up with parity of the stock. So if we're considering buying the Starbucks convertible in the secondary market for $1,300 and it is convertible into 25 shares of Starbucks, that means parity would be 52. And right now the stock is 50. So the idea here is unless you and I think Starbucks is going to 52, that doesn't make investment sense. Because if you're going to pay this premium, you have the expectation that Starbucks is going to go from the present price of 50 to 52. Let me show that to you again as it's related on the test. Let me clean up my slides here. And here we go. So here's the example we're working on. On the test, I say your client is considering purchasing a convertible bond in the primary market or at issuance, and you should know that means par. All bonds are issued at par for test purposes. It has a conversion price of 40. We said you can't do anything with the conversion price. You need the ratio. And so then you would take that and then you would say, okay, let me do the math. And common stocks trading at 50, 50 times 25 would be parity. Boom. That's when they're equal. And we would expect it to be trading at a little bit of a premium to that. If it was trading for less than that, there would be an arbitrage opportunity, right? So this allows us to switch our status from being a bondholder to becoming a common stockholder. That's parity of the bond. I go to the most likely scenario is this one. This is the more likely scenario. I say on the test, your client's considering buying a convertible bond for 130.
Premium.
130% of par, that's $1,300.
Hmm.
Your client's considering purchasing a convertible bond for 130 with a conversion price of 40. What is parity of the common stock? And you guys say, okay, well, I don't need the conversion price. I need the conversion ratio. That's based on par. Par divided by 40 is 25 shares. I'm back in business. And this is the one I said is testable. We're going to take the
Wait, sorry, but it's
yeah,
it's based on par. You're not dividing 1,300 by
always,
25.
always. The conversion terms are always based on when the bond was originally issued.
Okay, got it, got it. That's
Yeah, very
important.
testable, right? So we're going to take our $1,300 current market price of the convertible. It's convertible into 25 shares. And as I said, this is the test question.
No, but
I
this is my
say,
question.
Brian,
I
if you
thought I
buy
thought you
this,
just said, sorry, Dean. I thought you said it's always par divided by the conversion ratio.
oh, I'm sorry,
You're,
conversion price, my bad. We always need
convert,
the conversion ratio. The conversion ratio is based on par and never changes. When the bond is issued, that's when the ratio is established.
but this is not par. Why is it 1,300? I guess is my
That's now what
question.
it's trading at in the secondary market. Bonds are issued at par, but then they trade in the secondary market at a premium, a discount, or par. So I'm telling you that in the secondary market, makes sense, by the way, because remember the Starbucks was 38. Now the Starbucks is 50. So as that stock has gone up, so has this bond in the secondary market. You say,
Okay,
okay, I
so the
get a
bottom
bottom.
line is you're always taking the current market value price to get to the conversion.
Always, but that's the trick. I'm always using the current market price for
Okay.
parity, but remember the ratio is not dynamic, is not changing. That was based on when the bond was originally issued. So
Yep.
Starbucks says we don't care who's got the bonds. It's convertible into 25 shares of our stock, right? That's when the bond was issued. The bond was
Yep.
issued at par. It had 10 years to maturity. It has 6% coupon. That isn't changing. Starbucks says we have nothing to do with the secondary market. We're simply telling you that if you own this bond and you want to turn it in, you can be exchanged for 25 shares of our common. That is what we're telling you. Now, after that is said, then the bond trades in the secondary market, based again on two things: interest rates, and more importantly, the stock price. Yeah, I saw this guy being interviewed, Brian, and he'd borrowed billions of dollars and, his corporation. He said, well, don't worry about me. I'm not going to have to pay anybody back. And I thought,
Right.
man, that's a weird thing to say. And I was thinking, wow, that's kind of brazen. He said, no, 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 no. What I mean by that is all of my debt is convertible. And I'm going to just make damn sure when the debt comes due, that if I ask them if they want the stock, they say yes. Because if they say yes, then I don't have to pay back the borrowed funds. So at the end of this, I call you as your broker and I say, Brian, you know those convertible bonds we bought? Who cares what we paid for them? It's now 10 years. What do you want? Your $1,000 or do you want 25 shares of the common? It's a simple calculation. 25 shares times the current market price. If that's more than par, you say, I'll take the stock. If
Mm-hmm.
it's 25 shares is less than 1,000, you're going to say, I want my what? My principal back. By the way, I thought it
Yep.
was interesting. Then the guy said, what somebody called him out and said, well, that means there's going to be dilution to you. You're going to get diluted. He goes, yeah, so what? I'm going to own a smaller portion of the bigger pie. I go,
Right.
okay, well, that's kind of the attitude. I'm using Starbucks here, but Howard Schultz used to own 100% of Starbucks. He paid $8 million for the entire chain in the Northwest, but it was 7 stores. And he's been massively diluted over the years. Not because he's dumped the Starbucks stock, just because he kept issuing more and more stock,
Right.
right? Do the convertibles. Last time I saw, I think he's down to like 6 or 7%. You
Right.
know, I had the
It's amazing.
honor and privilege to tutor a grandson of a billionaire guy. We get some of these, get people coming to our business, and his grandpa is the founder of Little Caesars. I was telling him about how I missed this opportunity to invest in Starbucks very early in the life stage, and he told me his granddad missed it too. But he said would never buy Starbucks because why would somebody pay more for a cup of coffee than you could get a whole pizza from Little Caesars store?
Well said.
Well, that kind of makes sense. I mean, um,
Yeah,
P.S. I don't know. I don't track, the Forbes 400 that much, but I think his granddad probably has more money than Schultz. But
that's unbelievable.
but anyways, I teased him. I said, "Well, listen, when I say I missed it, I mean I didn't buy $100,000 worth of bonds in my retirement plan. Not that I, missed
Yeah,
hundreds of
exactly.
millions of dollars. It's all
Exactly.
relative, I guess. All relative. Okay, so I told you this is the most common version of this test question. Let me give you the most hellacious one that we could expect to see on our exam. I say a convertible bond is trading for a 30% premium in the secondary market. I say the conversion price is 40. The conversion price is 40. If the common stock is trading 2 points below parity, what is the common stock trading at? So this is the most hellacious version of this question that I think you could encounter. So let's just take it down piece
What was
by
it?
piece.
Common stock
So I'm
trading two
giving it to you
points
right now. I'm going
below.
to go through it again. A
Okay.
convertible bond is trading at a 30% premium
Right.
in the secondary market. So that means 30% of 1,000. That's
Yeah.
$300,
1,300.
1,300.
Yep.
So now we got that. So they've got the first piece of this, hellacious word problem. So let's put that there. It says it has a conversion price of 40. It has a conversion price of 40. So remember, we can't do anything with the conversion price.
Mhm.
What do we need?
We need to come up with a conversion ratio.
That's based on par. So we take 1,000, divide by $40 a share, and we get our conversion ratio.
Right. I see what
And
you
then it
mean.
says the common stock is trading 2 points below parity. 2 points below parity.
Hmm.
So what is the common stock trading at?
50.
Yeah, that was a lot of work, right? But
Hmm.
all right, let's try another one. Let's try another one.
Interesting.
Same scenario again. These are, I'm giving you the most complicated version. So, remember, it's not, if you tell
And
me
that,
you didn't pass the 7 because of parity calculations, I'm gonna say, I don't know if I believe that. Okay, so the other version of this is, let's say that we have established, let's go to our previous one. So here's our previous one. So you're looking at a bond, a convertible bond that the common stock is trading at 50 and the bond has a conversion ratio of 25. And you see that the bond is trading in the secondary market for less than parity, less than parity. So test question is, what should you do if you're looking at a convertible bond that's convertible into 25 shares of $50 stock and it's trading below parity?
I mean, if it's trading below parity, you shouldn't
Besides,
do anything
besides
because you're
calling
going
game. No, there's an arbitrage opportunity. There's an arbitrage opportunity. I say we should do is we should buy these bonds because the bonds are worth 1250 and they're trading at 1100. Let's buy 4 of them. If we buy 4 of them, 4,400.
Oh, I'm sorry. You were saying at the beginning you don't own anything.
Yeah, you don't know anything.
Got it.
So
Okay.
there's an arbitrage opportunity, guys. We buy these 4 bonds, right? And we're going to be out 4,400. We should buy as much as we want, but I'm just making it a round lot. So we buy 4 of them, we can get a round lot of the stock, right? 4 bonds, 25 shares each. And what I'll do is test point, I'll sell short the stock. I'll show short the stock at 5,000 to lock in that arbitrage opportunity.
Hmm.
So what we do here is if we see it's trading below parity, we do arbitrage. This is dollars out. At the same time, I'm going to do that. I'm going to sell short the stock, and the way I make delivery is by converting the bonds. Now, as I joked, I don't think you would ever see this situation in the secondary market because the market's a little more efficient than this. But you might
Hmm.
see a test question about arbitrage on the test. Arbitrage is profiting from price discrepancies. And they might give you
Okay.
a price discrepancy as it relates to this parity. And you recognize, whoa, I found a free lunch. As I said, it would be more typical in the real world that this would be trading at a premium to parity in the secondary market.
And I want to just make the distinction that the the difference in conversion ratio and conversion price. Conversion ratio is always going to use par
Always, always, right. So
to
that's why you got
calculate the conversion.
always, yes. So that's
Right.
why I cut the way I say that. The way I say that is you have to reset to par in the question because par isn't going to be in this question. It's going to be the price of the bond. And so what you've got to do is say, okay, well, I know that's based on par originally when it was issued, right? So here's our original example, right? Starbucks
Right.
issues the bonds. They are 10 years to maturity. The conversion price is 40. And we said none of that is going to change. And then we said that you can't do anything in terms of what you need to be able to do on the test with the conversion price. We said you have to establish the conversion ratio. That doesn't do you any good. You got to know this. That's what you got to know. You got to know how many shares. Let's try a different one. Let me get a whiteboard here. Let's say that I tell you, let's say I tell you that the conversion price is, we'll try a different conversion price. The conversion price is 50. The conversion price is 50. So what is the conversion ratio of a convertible bond with a conversion price of 50?
Isn't that just 1,000 divided by 50?
That's exactly right. But remember, you got to do that because you can't answer any question without first figuring out how many shares. And so what you got to do is know what the conversion ratio is. Here it's 20 shares,
Hmm.
right? So, be careful. If it's a preferred stock, a convertible preferred stock, par is going to be that. And let's say the conversion price is $10. I'm just making that up. Again, you have to figure out that the conversion ratio here is 10 shares. So I'm also wanting you to be careful about whether you're looking at a convertible preferred stock where par is 100, or whether you're looking at a convertible bond where par is 1,000. So par is different depending on what you're looking at.
Just to be really clear, they can't
Yep.
ask you the question without giving you. They're either going to give you. They
Yeah,
have to
they
give you the
got to give you the
conversion
conversion
price.
price. If they're nice, they'll just give you the conversion ratio, and you say, "Oh, thank you very much."
Right. That's
But
what I'm trying to say. Like
yeah, they got to
no
give
matter
that to you.
what, no matter what, they have to give you
That's
the
right.
conversion price. They may or may not give you the conversion ratio. That's what I'm
That's
trying to say.
exactly right. That's exactly
Okay.
right. They got to give you enough information. So I always joke with test takers, don't ever take the choice that says you can't figure it out. That's never wrong. That's never right. You can
Right.
figure it out. So it makes sense, by the way, because you're not allowed to tell the customer I can't figure it out. I mean, you can say, "Hey, Brian, I think I missed the convertible questions on my seven. We certainly have an expert here somewhere. Is it important to you? Because if so, we'll certainly find out for you." I'm not allowed to tell a customer, I don't know how to figure it out. Right.
And so on the when you do the conversion ratio, that's when you're always using par.
Always. That's always based on par, right? It's always based on par. So you got to have that par. You can't do the math without that parity calculation, right?
So when do you just to quickly summarize, when do you bring in the discount or premium scenario?
That's
It's
when you're
when you're
doing parity. So when you're doing the parity calculation, there's two parity calculations. Parity means equal.
yeah.
And so we said there's two: parity of the bond, and we're trying to figure out what is the bond worth if the stock's at. In our example, the stock was 50. The conversion ratio is 25. Test question: what is parity of the bond? 1250. Right? That was this one. And again, it's testable, right? So here's our example. The common stock is 50. The conversion ratio is 25. You would tell me on the test, parity is 1250.
Hmm.
And then we said the other one is parity of the stock. When is the stock price equivalent? We did this one as well. We say on the test, it's a convertible bond. It's current market price. CMP means current market price, 1,300. Conversion ratio is 25 shares. And we said paying $1,300 for the bond with a conversion ratio 25 shares is the equivalent of paying 52 for the stock. And again,
Hmm.
and based on that $52 price for the stock, that was this one, you would decide where you want to buy the bond. Because if you don't think the stock is going to go from 50 to 52, you shouldn't buy this thing. I say, Brian, if we buy this convertible bond for $1,300 in the secondary market, it's convertible into 25 shares, we would be paying 52 for the stock. You said, well, Dean, what's the stock at? I said, that's a good question because, that's really important. I say, right now, the stock is 50. You said, well, Dean, right now, it makes no sense. I said, well, Brian, right now, it doesn't make any sense, but what? The future, who knows what's going to happen in the future,
Hmm.
right? But that's what you'd want to know that, right? Because that's how you're making your decisions. Now, what are the advantages? What are the advantages to the issuer? If I'm an investment banker, you know, investment banker, I say, listen, if we add a conversion feature to bonds, it'll be easier for us to sell these bonds in the marketplace, in the capital markets. It'll
Hmm.
also lower the interest rate you would otherwise pay.
Hmm.
Now, more importantly, on Series 7, I say the advantage to the investor is I get the safety of the debt. I'm a creditor, and I get the upside of the stock because I can switch my status from being a creditor to becoming an owner.
Hmm.
And again, I want to be able to convert into the same proportionate ownership. What I mean by that is if Starbucks splits 2-for-1 or pays a 10% stock dividend, I need to adjust the conversion features accordingly.
Hmm.
There's potential dilution here, right? So non-dilutive means in the trust indenture, the covenants, the issuer agrees that if they do split their common stock or they do pay a stock dividend, they will adjust our conversion feature accordingly. So in our example, the conversion ratio was 25 shares. If this company pays a 10% stock dividend, I'm going to want to be able to convert into 2.5 more shares. my new conversion ratio would be 27.5 shares, right? Because I want to be able to convert into the same proportionate ownership,
Mhm.
right? Yeah, any more questions on that? You want to do another
No,
one?
I mean, we can do one more and then we can move
Okay.
on.
All right. So let's do one more. So I gave you an example of a conversion price of, I think, what I do, 50 or 20. By the way, it's always going to be, sometimes I get mad with test prep vendors because they come up with practice questions that would never exist even on the test or the real world, because nobody's going to come up with a conversion price. It's like 23.33. It's going to
Right,
be,
right, right.
it would be something aesthetically pleasing, right? I mean, if I'm your person, I say, what the heck are you doing, right?
Yeah,
All right.
totally.
So we said, let's just put up the parameters. We know it's going to be based on par. We should definitely know that par is always going to be 1,000 when we issue the bond. And let's say it has a conversion price of $25. And we said, regardless, before we move further into the question, we should definitely know that we can't do anything with the conversion
Without
price. So the minute I get a question, they give me a conversion price, I'm just going to stop immediately and say, I need to have the conversion ratio. So I'm just
40.
going to, my
Mhm.
official Prometric scratch, I'm going to take 1,000. I'm going to divide by the 25, and now I'm back in business, because there's some questions you kind of know where they're heading just from the minute they say something. Like the
Yep,
minute they give you somebody's tax bracket, it's going to be a muni bond question. Right.
yep,
So I mean, there's certain, kind of pivot words, if you will. So let's get our
yep,
conversion ratio. And we get our conversion ratio at 25. So we can get divide by 20, we get 40 shares.
yep.
And when these are issued, the stock is typically going to be below that. I mean, these at issuance are going to have the stock somewhere below that. So let's say that at issuance, the stock is $20. So the current market price of the common when the stock was issued, I'll just make it 23 and make it more fun. Okay, so now I say they love these kind of questions. Several years later, several weeks later, they give you a secondary price. By the way, the other thing I would warn you is they could just say at maturity. By the way, that
Hmm.
question's even easier, right? Because at maturity, I'm going to call you as your broker and say, Brian, the bonds have matured. Do you want 40 shares of the stock, or do you want your $1,000 back?
Yeah,
And we know what the answer is going to be, right? 25 shares times, 40 shares times whatever the price is. If it's less than 1,000, you're going to say, I want my principal.
yep,
If it's more than 1,000, you're going to say, I'll take the stock. All right. By the way, the existing shareholders have to vote in favor of the issuance of these convertibles because of the potential dilution.
yep,
So, we got to go to our existing shareholders and say what's going on. Okay, so now we say, let's just take our stock price. And, we're hoping, everybody hopes. I mean, the issuer hopes, I as a bondholder hope. We all hope that they're going to take the proceeds and build the business. And maybe the stock now is 32. I'm just making that up. And again, there's two potential questions here. The two test questions are, what is parity of the bond and what is parity of the stock? So let's do parity of the bond first. I say, as you recall, we can get 40 shares of the stock, which is 32. And so parity of the bond, being able to get 40 shares for our bonds, the stock's at 32, parity is 1280. And then based on knowing that that's what the bond is worth, it depends on whether we think we're going to buy it or not. I say, Brian, parity of the bond when they're equal is 1280. This is 40 shares of stock that you can exchange. The stock is a $32 stock. And so now it's 1280. And maybe I'm the one who bought it at par. You said, what you pay for the bond? I said, Brian, none of your damn business what I paid for the bond. What we're here to discuss is what you might be willing to pay for this bond.
Mm-hmm.
Right now, as it sits right now, the bond can be converted into 40 shares of a $32 stock. And so as it stands right now, that bond is worth 1280. And
Mm-hmm.
if you want me to sell it to you, I'm not going to sell it to you at parity, and I'm not going to sell it to you for less than parity. What am I going to want?
A
A
little bit more than
premium for
parity.
that, right? I'm going to
Yep.
say, listen, you're asking me to leave the party early. It's a happening party. You said, well, then it
Mm-hmm.
could go down. I go, well, Brian, if you thought that and I thought that, we wouldn't be having this discussion right now. We
Right.
both think the stock is going up. And so let's say it's priced at, I told you it would be typical that it would be priced at a premium to whatever the parity is, right? And
Mm-hmm.
so let's say that is the current market price of the convertible. And that would be typical. It would be trading at something less than that. Okay, now we said the other test question now is to figure out what is the parity of the stock. In other words, now what we're saying is if we do pay $1,300 for this thing and we do exchange it, what would we be paying for the stock? Because that's going to be important, right? We know it's
Mm-hmm.
probably going to be something a little north of 32, but how far north of 32 is going to be meaningful to us because, again, we're bullish on the company or we wouldn't be doing this.
Mm-hmm.
And so the way we're going to do that, we said test question is we're going to take the current market price of the convertible and we're going to divide. By the way, all the test is division. So if you're not dividing, you're doing the wrong math.
Mm-hmm.
I mean, that's, and then I would warn you, it's not high-end math. It's mostly division, but I had a guy, I'm making him sound like he's uh, more of a narcissist than he really is. But he said, Dean, I'm not paying you $225 an hour to teach me to do math. I can do any math. Give me any two numbers. I can solve for the third. And let's just skip that. And I said, I'm fine. Good news, he passed. But then he said, Dean, he said, I shouldn't have blown off the thing because what I didn't do is memorize the formulas because I don't need to because yeah, I can set it up and create my own formula and solve it. And he said, but then they didn't ask me to do the math. They asked me to recognize the formula. I struggled a little bit. I mean, I was able to do it because I could, set it up.
Yeah.
I said, well, that doesn't surprise me. And so I said, what you're telling me is you should have made a flashcard with the math. He goes, well, yeah. So, but
Yeah.
it's not, I always tell people that don't, I get some people that are really math phobic on as test takers. And I say, well, listen, you can't be getting on math questions because there's no interpretation of a math question. You simply get it right or you get it wrong. It's like break
Yep.
even options. You just either get it or you don't. And you got to save your misses for judgment questions where you go, oh, I don't know. Am I going to put that in there? Anyways, when we do this math, I'd say, listen, if we're considering buying this stock convertible 1300 divide by 40 shares, we would be paying 32.50 for the stock. That's parity of the stock.
Mm-hmm.
And right now the stock's 32. That's not bad. Actually, I think it would be a little more premium. I'd be willing to buy that at that price, but things are always attractive on my whiteboard because it's not the real world. My guess would be that that'd be trading at a little bit more than that. Boom. Right. So we said there's two things you got to be able to do. There's no draw. I'm wishing for you a dream draw. Everything you studied shows up. But
Mm-hmm.
there is no draw in which you are not going to have to do a parity calculation.
Mm-hmm.
And then, it might not be doing the calculation, but you can't answer if you don't do the calculation. Like, again, what should they do? Should they, take the stock or let the bond, get back their $1,000? So, it might be an intermediate step to answering the question, so to speak.
The bond matures question. You were saying, do
Yeah.
you get a
So
thousand
now,
dollars
yeah, the
principal? I said
bond
$1,000
matures.
time.
That's right. If the bond matures, now it's even a simpler choice because the bond matures at 1,000.
Yeah.
So, now at the maturity, this issuer simply says, what do you want? Do you want your $1,000 back? Because there's no secondary market once the bond is matured.
Right.
It's $1,000, right? So do you want $1,000 or do you want, X number of shares? They also could call the bonds, Brian, too. So I might call you as a broker and say, hey, those convertible bonds we bought? You go, yeah, Dean, I love those bonds. We bought them at par and I've been watching what's happening. They've been building the business. The stock has gone up. And I said, well, they're calling them from you. And you say, well, what do you mean they're calling me from me? I said, well, you have a couple choices again, Brian. You can either let them call the bonds at the call price, or you can convert. And you say, well, what should we do? I said, well, let's do the math and figure out if the call price is more than the X number of shares, we'll take the call price and turn in the bonds. If the
Right.
stock is worth more than the call price, then we're going to what? We're going to convert.
Yep.
So by the way, that's called, no, I don't think you'll see it on the test, but that's called a forced conversion. A
Okay.
forced conversion is when the issuer knows what you're going to do by the offer they made you.
Okay. Got
They
it.
say, Brian, we're tired of paying the 6%. So here's the deal. Either give us the bonds or, get the stock and no more interest for you.
Got it.
All
Okay.
right. So what else was on your list? You have,
Well, you mentioned muni tax. I mean, maybe do muni tax
okay, let's
quick,
do
and then
that.
mutual fund NAV.
Okay, cool. So let's do that. Let's do munis first.
And
Um,
this is all in the PowerPoint you sent Jenna. You sent it
I
today.
did. Yeah, I sent that to her this
Okay.
morning. So
Awesome.
I sent that to her. I sent you a page supplement. I don't know if I mentioned it to you from my friend called the Test Geek, Brian Lee. And Brian,
Hmm.
I sent that to her as well. And what's in there that is what I want you to put away is a very good practice test. And when you're
Okay.
ready for your final mark, take that practice test, and that score will reflect the actual exam itself. Right. So
It's not inflated in terms of the difficulty.
no, nope. It's pretty spot on. So good news or
Do
bad
you,
news. I mean, if you get a bad score, so if you
yeah,
get a
like what
bad
do
score,
I
that's not
do
going to
if
be
I'm
good.
just
But
like falling short? Should I just
yeah.
delay?
Well, what I say to people about it is if you're feeling kind of confident as your tutor, Brad, I wouldn't think you should worry about it. But if you don't want to take that and go, oh my God, I'm stuck because I don't have enough time for remediation. Maybe you take that 2, 3 days before your test date. If you're feeling good and you're getting mid 70s on your practice tests, which is that's I'm a lot lower than what other people think you should get. I don't think you're at risk if you're getting mid 70s. But that being said, if you're getting mid 70s, no risk. Maybe you do it the day before, 2 days out. So the more confident you are, the longer you can wait to take it and get that final mark. The less confident you are, based on your own psyche, based on your test scores, you'd want to take it a little further out. So if you think you're going to need more remediation, there's time to do so. It's not going to do any good if you take this thing the day before and you need remediation. It's kind of too late,
How
right?
many Q bank questions or exams do you
Well, I
recommend
think you're
someone?
using Knopman, right? Knopman uses the Kaplan Q bank, and there's like 3,600 plus questions in there.
Correct. So,
So,
like, how many of those 3,600 should I be doing?
well, listen, I know that you guys are not baby brokers and got 40 hours a week to study for Series 7, but
Right.
the more the merrier. I would want you to commit to a daily discipline you can live with and give yourself permission to take a day off. I would be more interested in practice tests after you've done reading and you've done the work on like options or
Yeah.
whatever. I would be wanting to like if you're testing like next week. I just had the previous tutoring session, and I said, "Well, how many practice test marks are we going to get between now and the test?" And I said, I would like 2 or 3. They were testing in a week. I mean, don't overdo it because we're not trying to learn by missing practice
But you
questions.
don't think I should be doing like 2 tests a day?
Well, I think you guys are unique. I don't think, Brian, you're going to burn yourself out. So in your case, maybe you can do that. And I
But
think
when
in
you
your
say you're confident in me, like, why are you so confident in me? I mean, I'm
well, because
flattered, but like,
I spent a couple hours with you so far on the tutoring, and I can kind of guess from our discussion on options and this discussion that you're not in left field somewhere. I mean, you're in the ballpark, knowledge base wise. Have you taken any
okay.
practice tests yet?
Yeah, I mean, but test is misleading. I've been doing the individual units,
Well, no,
one
do a
section at a
cumulative.
time.
Let's do a cumulative one. Let's find out, right? That's what I said. Let's find out. So do a
Right. Okay.
complete practice test. Let's see what that score is. I told you my expectation is I want you in the mid 70s. So
Okay.
if you get between 60 and 70, many people pass, but you're at risk. We don't want you to be at risk.
Hmm.
So,
Okay.
I was doing a corporate class for this cohort of these people at this corporate financial institution. 20 people, they take the practice, the mastery on Friday, they test on Monday. And there were 20 people. And I said, listen, we got 16 of them that scored over 70. I think Monday they're going to be fine. We have 4 who did not get over 70. Doesn't mean they're not, well, 4 of them between 60 and 70, and half of them aren't going to make it. And she goes, well, which half we can fix that? I go, well, I don't know which half. It's just statistics. There's no reason they shouldn't pass, but when people get between 60 and 70, they get wobbly, they don't close strong, and for whatever reason, they don't make the mark. Below 60 is knowledge deficit. They don't even know what they're being asked. I was proud. The four people that were between 60 and 70, they passed. They didn't get wobbly. They kept working. But ideally, we would want to have a mark where we have the expectation we know you're going to pass, right?
No, that's
All right.
fair. I just wonder if do I have enough time? Because I've been doing, I've been getting between 60s and 90
Oh, well, that's
on
great.
the
So do
unit.
it,
No,
do
no,
it,
no, 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 on the unit. Like, so when I'm
do it. So
exposing
let's agree.
myself,
Let's agree. So action items. Let's agree you're going to do a practice test.
yo,
Right?
tomorrow
Cumulative
morning,
simulated exam.
I'm gonna do
Yeah.
one or two
And
tomorrow morning, but I'm saying
send me
like,
an email, send me an email and say, hey, Dean, I just finished it and here's what I got. So let's get that score. And then we
okay,
can know whether we need to just need to stick the landing. I kind of joke, Brian, I call it the 747 principle. It takes a 747, 120% of rated power to get off the ground. So we need to find out, is Brian seat back, nose up, trying to get off the
yeah,
ground? Or it only takes 70% of rated power. So if you're hovering, many times in tutoring, particularly this week, it's been a good week. I have a lot of people that I've been able to say, hey, you just need to stick the landing. That's
okay,
right where we need to be. Sometimes I go, listen, you're still in the seat back, nose up. You got, you need to be doing more than you're
no,
doing.
totally.
Right?
I just
So,
wonder, do I have enough time with 10 days left to
oh yeah, I
do?
think you have plenty of time. I mean, I'm an
Okay,
optimist, but yeah. And then I told
okay,
you,
cool.
I'm pretty impressed as people like yourself go. This is your whole cohort of people I've dealt with. It looks like you're spending more time carving out the time necessary to study and do things. And so that's always a good sign. I have a lot of people, I get it. They're busy, they got families, they got deals going on. I got a guy, listen, he's got like $1 billion deal, and I get it. He's not going to be studying for a seven if he's going to lose, lose a deal.
Yeah,
So,
yeah.
so it's a little tough, but you guys have been doing a good job. All right, so back to this. We don't think that somebody takes their last buck and buys a muni bond. We think that if you're buying municipal bonds, you have other investments in your portfolio. That's a correct kind of an assumption. We further assume that you wouldn't be, opposed to buying a muni bond at a premium to capture a higher than today's tax-free return. Because remember, if the bond is trading at a premium, that's because interest rates have gone down.
Hmm.
Now, what the IRS thinks you'd like to do is buy this block of muni bonds for 120, buy 100 of them, $120,000, and take that $20,000 loss whenever it's convenient for you to offset gains you have in your stocks, for example. And the IRS says, no, 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 no. You, if you wish, can buy a muni bond at a premium, but you don't get to decide how to set it up on your tax return. When you buy a muni bond at a premium, you have to do straight line amortization downward called decretion. This is a 50% probability that you'll receive this kind of a question. So
Hmm.
when I'm debriefing people, I say, hey, did you have to do this decretion thing? Half the time people say, yeah, Dean, I had to deal with it. The other half of the time they say, I didn't see it. Now let's
Hmm.
be clear, parity, you can see it, my friend. We
Right.
know you're going to see that. All right, so an investor purchased a muni bond for 1,120. So first thing you have to recognize as a test taker that indeed this is a muni bond purchased at a premium.
Hmm.
And once we knows that, then you say, I remember this. I don't get to set that up on my tax return. However, I'd like to. The IRS says you're going to take that loss and little itty bitty hits along the way. That's going to prevent you from, realizing the loss when it one fell swoop. So the first thing we have to be able to do to get this question right is say, okay, we have to do straight line amortization upward or downward. Upward is called accretion, downward is called decretion. And so let me change my color here. And so boom. And so we say, okay, we're going to lose $120 over 12 years. So again, what you have to do on your tax return is take that $120 and take it in little itty bitty hits of 10 years a year, $10 a year. So for example, at the end of the first year, I was joking, but Zoom changed their toolbar today. I feel, Brian, like I'm getting like gonna be an old guy. Like, don't change my toolbar. I like my old
Yeah.
toolbar. I don't want the new one, right? So
It
I'm
was
sure,
working great.
or at least give me a button where I say no. I'll keep the old one. I don't want the the new one. So here, the first year, I'm going to amortize it downward. I'm adjusting my cost base downward, $10 a year.
Yeah.
So after the end of boom, whatever it is. So here it says our next thing, and we say we've had it for 6 years. So if we've had it for 6 years and we've been amortizing downward,
It's just 10 times 6, 60, 60
well,
minus.
be careful, be careful. We got it. It's $10 a year, and we've had it for how many years? 6. So yeah. So your point, boom. So that's going to be $60. So that's our adjusted cost base.
Yeah.
And then we sell it, it says in the question, for 1,030. So that's a loss of $30. So
Wait,
again,
sorry. Oh, I missed out. Okay. I
yeah,
understand the 1060,
yeah, but remember
1060.
here it
Then what?
says we sold it. So let's just put that there. We sold it for 1,030 and our cost base was 1,060. So we have a
I see. Yep.
$30. That's our $30 loss that we have there. And it's the difference
Yeah.
between those two, right? Let's just
Yeah.
review. Let's just go back and review. Boom, 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 boom. We're doing municipal bond math. We said that municipal bond math, 50% probability is they give you the scenario. Here's the question on the exam.
Hmm.
Very much a question like this. Investor purchases municipal bond for 1,120 with 12 years to maturity. So you say it's a mini bond at a premium. I got to do straight line amortization, downward decretion. I got to take this loss and little bitty hits along the way. So if it's 120 over 10 years, I got to adjust my cost base $10 a year. I've had it for 6 years, so $60. That's my adjusted cost base. Then they tell me I sell the bond for 1,030. And I say, okay, well, if I sell it for 1,030 and my cost base was 1,060, I lose $30. Boom. You see how we got the $30 loss?
Yep.
What if I would have sold it for 1,060? I would have neither gain nor loss, right?
Right.
Because that's my cost base. What is my cost base at maturity? 1,000, right? Because I've already written it down all the way. So I wouldn't have a gain or loss at maturity if I chose to hold it to maturity. Because I'd be taking,
Because,
yeah, because I would have
oh,
taken this $10 along the way. So when I get
right,
all
10
the way
times
in, yeah,
120.
yeah.
Yeah. Yep.
All right. So another math is going up. I'm not going to make you do this one. You just need to know it needs to be done. So I'm not going to make you do the math. But if we bought an OID, a zero coupon bond for 500, let's say, and it matures in 10 years, there'd be $50 a year in interest that we're receiving. And we would, if it's a corporate or government, we owe taxes. Here it's a muni, so we don't. So this one, I'm not going to make you do the math on the test. I'm just going to make you recognize it. So for bonds originally issued discount, we do straight line amortization upward called accretion. And for muni bonds bought at a premium, we do straight line downward called decretion. Tax calculation is very testable. The number one reason that people buy muni bonds is because the interest they pay is federally tax exempt. Now they're going to be taxable to non-resident investors. So if I'm a resident of California and I buy a Nevada bond, California can and will tax me. You say, Dean, I want to diversify my muni bond portfolio geographically. And the way you've explained this to me, if I'm a resident of New York City and I buy a New Jersey bond, the New York City and New York State can and will tax me. I said, Brian, that's exactly correct. You say, Dean, are there any bonds that no matter where I live in the United States of America, they would be exempt at every level, state, city, federal, triple exempt? Now, there's not a lot of cities that do have city income taxes. Philadelphia is one, New York is another. San Francisco's been talking about a city income tax for forever. I say, yes, this was on my Series 7. Puerto Rico. The US government could tax you on Puerto Rican debt, but chooses not to
Hmm.
give you an incentive to invest in a territory. Now, we don't need to review the empire. It's not going to be US Virgin Islands or US Micronesia or, DC. It's going to be Puerto Rico. They love
Hmm.
San Juan, Puerto Rico. Now,
Okay.
stupid. Let's just be clear. Honolulu, Hawaii, and Juneau, Alaska are not territories of the United States government. Right?
Yep.
So it's a
Yeah.
geography question. If
Okay.
anybody wants Puerto Rico to be a state, it's the other states.
Got
Now,
it.
You say, Dean, I'm in a 40% tax bracket. I say, well, Brian, you're pretty blessed. You know, the more blessed you are, the higher your tax bracket.
Mhm.
And Brian, what we're trying to decide is, should we put a corporate bond in your portfolio, or should we put a muni bond in your portfolio? And it's very important to make sure that we make fair comparisons.
Mhm.
Fair comparisons. It's not fair to compare a 10% corporate bond to a 6% muni. What we really need to figure out is, what is the better deal for you? What is the equivalent yield? I said, well, in a 10% bond, you're going to get $100. So you should know that's $100, 10% based on par. So you're going to get an annual interest $100, but hey, the US government's going to confiscate from you $40. And so what you're left with is $60. Now, Brian, if I buy you a muni bond, you're going to get a 6% muni, you're going to get 60, but you don't have to pay taxes on it. In your tax bracket, Brian, getting 10 and paying taxes is the same as getting 6 and not paying taxes.
Mhm.
The taxable yield of 10 is the tax-free equivalent of 6. The tax-free equivalent of 6 is the taxable equivalent of 10. Now, on the test, they're not going to be equal. So here's our test question. Let me clean this up. So we're going to be asked on the test what the customer should do based on their tax bracket. And so, boom, let's get rid of all this. And here is the setup on the test. The setup on the test is, your client is considering buying a corporate bond at 8 or a muni bond at 5. The customer's in a 20% tax bracket. So what we want to do is figure out, what is 8 in your tax bracket worth? Now, as I told you, the minute you get somebody's tax bracket on this exam, the minute you get that tax bracket, you know that this is coming. You know, that's just a
Yeah.
hint that that's what's coming next. And you're always going to need to do 100% minus the tax bracket. I mean, that's the point here. You know, I think of it, you can think of it any way you want, but I think it kind of is like the government's going to confiscate from me 20% of everything I receive. I mean, you know, taxes are the price you pay for civilization. And the more civilization you want, the more taxes you should pay. I'm joking, but, kind of, right?
Yeah.
I'm having an adventure with my brother. My brother decided to build a place off grid. I said, sign me up. I'll build a place next to yours, Chris, off grid. And mom was almost 80 and retired, and I take care of mom. And, him and her are talking about she's going to move out there. I go, Mom, you can't move out here. There's no infrastructure whatsoever. There's no
Yeah.
hospital. There's no senior center. There's no policemen. I mean, so, we can visit the cabin, and maybe long term we'll try and figure out something for you. But hey, in Las Vegas, I call 911. May take them a while, but there's somebody on the way, so to speak. All right.
Yeah.
So what we're going to have to do here is take 100% minus your tax bracket and find out that what you're really left with after you're paying your taxes is 80% of that return.
Mhm.
And so in this example, you could either use the taxable yield, or you could actually use the dollar amount, however you want to do it. But here, that's a challenge on math, because there's a lot of different ways to do things. So in this example, I say, Brian, in your tax bracket, getting 8 and not paying taxes, or excuse me, getting 8 and paying taxes, is the equivalent of getting 6.4.
Mhm.
So I'm sorry to tell you that you are not rich enough to buy a muni, because here the 6.4 is better
Yeah.
than the muni paying 5.
Mhm.
So, boom. That's our first version of this. Now, our second version of this
The other way around.
is the other version of it, right? We're going to go the other direction. So let me just clean this up here. Boom. Again, I'm kind of pissed off with
And
my.
how do you remember like one's divide, one's multiply? I mean,
Yeah, that is a challenge, certainly. Um, Taxable to tax-free, we're going to multiply. Almost always on the test, it's going to be division more often than multiplication. Almost always. So I don't know if that's helpful. I don't have any tricks for that in terms of that, right?
okay.
So here's our other version of this. Now, I told you we do have pivots, though. I guess I would tell you this. Let me put it this way. Maybe this is helpful. Usually we don't give you both in the question. So usually they're going to give you one or the other, right? So here we're making you do the comparison based on two of them, but it's going to be one. And so if it's a taxable yield, we're going to multiply. I think it kind of makes sense taxable multiplying because the government's taking the money from you,
Mm-hmm.
right? So we're multiplying by what net you're left with.
Yeah.
Earlier, I said, Brian, you're in a 40% tax bracket. So that's going to be multiplication on your taxable return because I'm going to say, well, geez, Brian, in your tax bracket, you only get to keep 60% of the return because 40% is getting eaten up in taxes. And then if it's I start with the muni, then we're going to make the muni go up. I guess that's one way I would say it is when I'm going from taxable to tax-free equivalent, the number's going down.
Mm-hmm.
It's going to be a lower number. And
So
when
you're
we
gonna
go the
divide.
other direction, it's going to go up, right? Because
Right.
you get
Yeah.
more. So maybe
That's a
that's
good point.
all right. So let's do the math here. So we're considering buying a 5% muni. By the way, the other thing I would tell you is that in any suitability question that becomes a math question, we kind of want to embrace that because suitability or judgment questions, and even I miss them because I think you should be fully equitized till you're 100 years old. But when we can get a math question as a suitability question, that's kind of helpful. So I told you
Mm-hmm.
we're always going to have to do this part. So the minute I see the 20% tax bracket, I just go, okay, I'm going to have to deal with that. Whoop.
100 minus 20,
Yeah,
80.
always. I mean, so the
Yeah.
minute I get that, it's kind of like that conversion ratio. The minute I see this, I just say, okay, I know where this is heading. I better take that 100% minus the tax bracket because whether I'm going taxable to tax-free or tax-free to taxable, I'm going to have to do that. And so
Mm-hmm.
I'm going to take that 80 here, the 20%. And now I'm back in business. I'm going to take the 5%. That's our tax-free yield. And now we're going to divide by 0.80 or 80%. And we find out that getting 5 in your tax bracket, 5 divided by 0.80 is 6.25. So I say in your tax bracket, getting 5 taxable is the same as getting 6.25 and paying taxes. And again, here is our reveal. Our reveal, boom, says that you shouldn't buy the muni because the corporate pays 8 and 8 is north of 6.25. Right. So that's a way we're proving that indeed the guy, we're just doing the other direction, but it proves the guy isn't in a high enough tax bracket to have this make sense. But again, we were talking about bond math. This math is testable. So I told you decretion, 50% probability, parity, 100% probability. This
Mm-hmm.
math, 100% probability, you're going to have to do this. Now, the one
Okay.
that shows up most often is this one, where we have to take the tax-free bond and come up with taxable equivalent. That's more likely what you're going to see. As I've said, almost always the more likely scenarios you're going to be doing division and not multiplication in the current
And
year.
in this example on the very bottom, like
Yeah.
what is it? 8%. Your point, I mean, I understand this. Your point is basically the muni bond is not enough, right? So
Yeah, the muni bond is not enough because you're in a low tax bracket, right?
right.
I
You
was,
stick
my
stick
accountant
with
was
the
telling me,
corporate bond.
yeah, I was talking to my accountant and I was so happy. He goes, Dean, why are you so happy? I said, I can't believe that's all I owe in taxes. I mean, man, that's the lowest I've ever owed in taxes. He goes, Dean, you're in the wrong spot mentally. This is not good news. I
Yeah.
go, what do you mean it's not good news? He goes, it's not good news because that means you didn't make as much as you usually make. I go, hey, why do you got to rain on my parade?
Yeah, yeah. Yeah, why do you
So,
gotta make fun of me?
so yeah, here's the guy, right? This is the problem. The problem is not so much of this.
Yeah, if it was 40, it's a different story,
Yeah,
right?
oh, then yeah, let's do it real quick on 40, right? At 40, this becomes pretty attractive. 40 divided by 0.60, that's 8.3. And if that's
Yep.
a New York City bond, woo, who knows what kind of tax bracket you can be in. The Puerto Rico
Okay.
bonds, just before they defaulted, there's no such thing as a free lunch. And they were paying, oh my God, the last coupon payment that they were able to issue in the Gala markets. Like, I mean, this is so stupid to be hazarding your principal to get the tax free. I mean, who cares if they default? You're not going to get that anyways. But the tax equivalent yield on the last issuance of the Puerto Rico bonds before they defaulted, for somebody in New York, it was like 11.5% or some crazy thing. I mean, you're almost getting a
Exactly.
private equity return in a muni. So crazy.
Exactly.
All right. So that ends today's session. I'll see you next time. And I sent that information. I'll send this link to Jenna.
Yep.
And then I have you. I see again. I moved your session you wanted to move to my off-grid location on whatever date that is. It's a Friday. So I'll see you then if I don't see you sooner.
Can you do next Thursday as well? Just out of curiosity,
Let me just check my calendar real
when
quick.
you're off the grid.
Yeah, I'll be driving Thursday afternoon. Just if you want that, just either yourself or Jenna book it, and I'll move it to Thursday afternoon because I have
No,
that block.
in addition to Friday, I'm saying
No,
if you have
I get
Friday.
it. But just book anything and I'll move it.
Okay.
I don't want to open up Thursday because it's like an airline flight. If I open it up, then
Yeah,
everybody,
people just hammer
I
it.
don't mind spending an hour with you off grid, and I've given you the
Okay,
disclosures. I don't want to open it up and all of a sudden I got 4 people that want to be tutored for my off grid cabin thing.
I get it.
Yeah, so just book it, and when I get it, I will move it to that Thursday.
Okay, I'm gonna take
Okay.
some exams this weekend holistically, and
Yeah,
I
we
defer to
need a
you to tell me
practice
if I'm
test.
not ready. But
Yeah, no,
punt and the whole thing.
listen, I'm pretty good. I'm, pretty good at kind of guessing what people are. I'm very rarely surprised. I'd be very surprised if we're not where we need to be. I mean, you may
Okay,
not be getting the scores you'd like, but we're in striking distance. There'd be no reason I would see, based on that score, we want that score, that we should put it off. I think we should stick to
okay.
that
Because
date.
I'm like, do I push this by 3 weeks, or like part
No,
of me
no,
is
no,
like,
no,
I
no.
just got to get this
No,
over
no,
with,
no,
and
no, don't. And and I tell you, by the way, if it comes time to push, I'll tell you to push, but I don't think that's a decision we need to make, and I don't think it's one we're going to have to confront. I think the scores are going to be close enough that even if we're disappointed, we're going to have enough time to work and get them to where we need to be. So, and then
okay,
when people push, they get an artificial sense of relief instead of the real relief that they don't have to do it. So I have
yeah,
a young
totally.
lady, and she's driving me nuts. I mean, she's paying me, I'm her tutor, but every time we get on the next session, oh, I moved it again. I go, will you stop that?
Yeah, just do
You
it.
kind of need to take that date because your brain is drawing you to the date. And again, I would tell her if I thought she wasn't going to pass, I'd tell her. But it's just what happens if you keep pushing and you keep trying to do it. At some point, you start forgetting the stuff you started with.
It's hard to retain it. Like
Yeah,
you need
exactly
to
right.
kind of, yeah,
So
yeah,
yeah, so the other reason I believe in cramming it and getting it done is because of that. It is hard to retain. So if you go, you're not doing yourself a favor. Sometimes people say, "Oh, I'm doing my serious stuff in 8 months from today, and I'm starting my study effort. Now I got plenty of time." I go, I don't think so. I think you should reverse engineer. You need to be 8, 10 weeks max, and that
yeah.
for a lot of reasons. One is what we're talking about, retention. Now I get it, as we said, when there's other things going on, but
But
even
that's the only problem. Like I haven't been doing it 8, 10 weeks is full disclosure. But like, if you look at my book, I mean, the level of
Oh, I
highlighting
love
I
it.
have,
Oh, look at that. Woo. You got the
yeah,
little, what are those things called? The little tabs. I
the
love it.
tabs, yeah,
Man,
yeah. I've got a
I
lot
keep
of
telling
them.
people
Yeah.
passing this test is more a function of dedication, discipline, and organization than it is other things. So that's impressive. I am very impressed. Again,
Yeah.
you showed me that book. I've talked to you just based on just showing me that book of the video screen. I think we're going to be fine. And
Okay, I appreciate it, Dean.
however much time you spent, you obviously spent some time, and this drives me nuts. I don't know why people, Brian, always ask me this. I guess they think I'm going to change my answer. Should I read the book? Yes, you should read the
Yeah,
book. And
yeah,
I love it when somebody says they're reading it, show me their book, and they're reading it. I'm like, whoa.
yeah.
So, I
Absolutely.
make more money tutoring from people who don't read the damn book.
I can't even
So
imagine.
I mean, I always think tutoring should be kind of like where we're using. Ideally, tutoring is used to plug the gap, not because you don't want to read the book. I mean,
Yeah,
I mean,
100%.
yeah, I don't think you want to show up on the screen. I'm reading the book to you. So
Right.
I had a history professor once. He drove me nuts. Um, and it was because all his finals was like he would like read the book, and he was giving me a hard time about why I don't show up in his class. I said because all you're doing is reading the book. I don't need to come to class to read the book.
I already read the book.
I can do that on my own.
Yeah, totally.
All right, I'll see you for our next session.
Okay, thanks,
Okay,
Dean.
bye bye.
See ya. Bye.